You have probably seen your own portfolio copied many times. What is your opinion? Is it good or dangerous?
One has to also remember that the ability of taking risk will be very different for different investors.
For someone watching this who has been delaying their mutual fund journey for a while, what is the most simplest, sensible step they can take today without overthinking market levels?
I mentioned earlier also, equity investing is about being optimistic. If you're optimistic on the future of India, if you're optimistic on the markets going forward, then you should get invested.
At 5 Paisa, we believe investing doesn't have to be complicated. Every day taking charge of your financial life is important. And today I have the privilege of starting the pioneering series Mutual Funds Ke Maharathi with none other than Sunil Singhania. Sunil, thank you for being here.
Thank you.
Over the past 3 decades, he's earned a stellar reputation in the market as being one of the finest investment minds and has been a star fund manager at Reliance and now founder at Abakkus Asset Management. And I look forward to talking about the markets and having some rapid fire questions from him. And hopefully our audience can take out some real gems of investing, starting their mutual fund journey. Thank you, Sunil.
Thanks for having me.
I just have a few questions. We'll get straight to it. So one, Sunil, Abakkus Mutual Fund is a new fund house, but you are clearly not new to the market. For a retail investor starting with a 5,000 rupees SIP, why should they trust a new AMC?
So again, thanks a lot for having me. You are right, we are a new fund house, but we always say that we are a new fund house with decades of experience. And in my earlier avatar at Reliance, which is now Nippon Mutual Fund, I spent like almost 15-16 years. Abakkus has been in existence since 2018 through different products, which were again listed Indian equity focused. And I think mutual fund is a natural extension of what we believe we are good at and what our passion as well as our expertise lies, which is investing in the listed equity space. And that's the reason, we finally took the plunge of launching a mutual fund. So I think from an investor's perspective, equity investing is all about the future. It's not about the past. Yeah. And, you should invest if you believe that India is a great economy for the future, and you should invest in I would say asset managers as well as different fund classes where you believe that future is going to give you returns. So, that would be a small pitch from our side.
You are widely known for your small cap track record. And when Abakkus launches its Flexi cap, its first scheme as a Flexi cap fund, what is the message to the investors?
No, I think, yes, we are known to be stock pickers because we do a lot of research in-house. But it's not that we only invest in small companies. I think over the last 2-3 decades, we have seen good performances across sizes of the company, because investing, whether it is in large, mid or small, is actually the same. You are investing in businesses, you are taking a call on the management, you are doing your study. We are very balance sheet focused, so we read balance sheets across, whether it is large, mid or small. The reason we are known maybe for mid and small, because we have in-house research, we are bold to take calls in stocks which not too many people cover, and that's why we have that thing. I think FlexiCap was a good start from a mutual fund side. It gives us a lot of flexibility because you can take calls across market caps, and I think it was very logical for us given the dynamic nature of the market, and particularly what has happened over the last 6 to 12 months in terms of various headwinds coming in, to have flexibility. And I think that is what we have done in our Flexi cap. We have been a little bit different. A lot of Flexi caps have technically become large caps because they have 90-95% of their exposure to large cap. Our Flexi cap, we want to run it like a true Flexi cap. And I think that has been what we believed in. After that, we have launched a small cap fund also. So we do believe in that. And, we are in the midst of launching the third series, which will be the large and mid cap. So,
Sunil, do you think that it's for first time investors going directly towards like a small cap fund versus a flexi cap, and what in your opinion would be a better approach?
So, for an investor, obviously every investor will be very different. I would always say that India is a country of entrepreneurs and India is a growing economy. And we always say that, the first $1 trillion of our economy was contributed by really old age sectors. like steel and cement and textiles and tea. And if you see the Sensex 30, 40 years back, it was very, very different. The second 1 trillion to 4 trillion, you had the private banks come in, the pharma come in, the consumption play come in, the IT services come in. I think 4 to 8 will be again new sectors which will come in. Obviously some of the old sectors like banks and utilities and all will also contribute, but a lot of new companies. We are now more into consumption. We want capital market plays. We want asset management plays. We want niche pharma. We want niche consumer products. And I think all these would be in the new age and the new entrepreneurs base. So I think as the economy changes, you have to be very clear that you are also participating in that. And those companies predominantly will be in the small and mid cap side. So if you are young and if you have time on your side and if you don't get hassled by day to day what is happening, I think you'll always make more returns on the broader markets. But obviously, 100% of your investment cannot be there because they tend to be volatile. So as I said, based on the risk profile of the investor and the duration of the investment, you should take a call.
Great. Many investors feel that when they are investing in Sunil Singhania is when they invest in Abakkus. But mutual funds are built on process, not personality. So what are investors really getting?
No, I think we also keep on thinking about it. But very funnily, I'll tell you, when I started Abakkus in 2018, and when you go to some mall or you take a flight and people recognize you because, they have seen you for so long on media and all, they used to first, shout and say Sunil Singhania. I think now they've started saying Abakkus. So over the last 8-9 years, we have been able to create a little bit of, I would say, brand recall even for Abakkus. Now, just to give you a perspective, we have 6 fund managers now across, actually 7 because we have a small private equity fund also. So it's not only Sunil Singhania. Obviously, they have seen me for so long. But that used to also happen when we were in Reliance. It was all about Madhukela and Sunil Singhania. So that always happens. Or even if you take some of the other well-known funds, for HDFC it was Prashant Jain, for ICICI it was Naren and so on and so forth. So you identify the fund house with a thing. But ultimately, you have a lot of people. And we have a very, very clear process. We have a clear investment philosophy and we have a meets framework, which is, absolutely clear and we follow it to the T. So I think 24 member team on the research side, we track 450 companies internally. And now with this AI being used, I think we intend to take this 450 companies to 650 companies being tracked internally. So, it's a whole machinery which is there.
So every quarter, many retail investors look at public portfolio disclosures and try to copy successful investors. You have probably seen your own portfolio copied many times. What is your opinion? Is it good or dangerous? And if it is the latter, why?
See, I think investors get confidence when, I would say investors who are known to be stock pickers, they invest in some companies. And rightly so, because they do believe that if some well-known investor has invested, then there would have been a proper research behind it. However, one has to also remember that the ability of taking risk will be very different for different investors. And the sizing might be very different. If we buy a particular stock, maybe it is 1-2% of our portfolio. And we can live with that stock not doing as well as we anticipated because it is impossible for us to be 100% right. But when we create a portfolio, we size it. So we know that even if we go wrong in 1 or 2 stocks, it will not hurt the portfolio. And I think that is what the investor should understand. The other thing is, we have the right to sell, right? If the stock is not performing the way we expected or the price moves up, the investor will not know that. Because we are not going to disclose our portfolio on a daily basis. So I think investors have to be cognizant of these things. So just blindly copying, you're not going to create wealth. I think the best thing is to invest in our funds, exactly. So you automatically get the benefit of the things.
Index funds are cheaper, simple and difficult to beat in many markets. So why should a retail investor still consider paying for an active mutual fund?
So you're right. In many markets, it is difficult because those are mature markets. Now, I just mentioned to you that the path from 0 to 1 was contributed by very different kind of sectors. 1 to 4 trillion was contributed by very different sectors, and 4 to 8 will be contributed by very, very different sectors. Those sectors and those companies and those entrepreneurs start small. By the time they come in the index, you would have already missed a big chunk of the returns. So I think in a growing economy like India and in an entrepreneur-driven economy like India, I think there is still scope to create alpha. And I think as long as we are able to create alpha, there will be place for active fund managers. In the large cap space, though beating is becoming a little tough, and therefore there is still merit of investors looking at passive investments.
Yeah, no, I think you make a very important point because, say, I mean, at least in the bigger markets like US, which are more matured, index investing is plain vanilla. But in India, there's so much wealth is being created through small cap stocks and some of the ones which. Your meets framework includes timing, but for retail investors, timing the market is usually called a mistake. So, what does timing mean in your framework?
Yeah. So it's very relevant. So I mentioned we follow this framework very thoroughly and to the T. So M is management. But even for management, we say that the ROC should be 13, 14, 15%. That is a quality of a good management, which is discipline of capital allocation. E is earnings. We don't invest in loss-making companies. Typically, we like to invest in companies where earnings can double in 4, maximum of 5 years. The second is event trends and disruptions. We are in a disruptive world. And market price is equal to EPS into PE. EPS is earnings. PE is perception. Yeah. So a recent example is IT services. Earnings have not gone down. Yeah. But the perception, because of disruption from AI, has gone down. And therefore, stock prices have fallen 30, 40%. Same is the case with media, whether you see TV channels or even newspapers. We read newspapers, the next generation is all on digital. And therefore, the PE multiples have come down. T refers to timing. We can't time the market, and we are also not trying to time the market. What we are basically saying is stay away from momentum. The theory of mean reversion works. If you are patient, if you have identified your stocks, don't chase them. Don't chase themes just because the theme is looking exciting. So yes, defense and EMS and railways and so many themes keep on coming. They are good themes, but don't chase blindly. Wait, you will get your opportunity. And that is what timing refers to. And S is a structural play. There will be some companies and sectors where there is structural growth. There you will have to pay a premium.
Great. My next question is, everyone wants quality businesses, but quality is expensive today. As a fund manager, what do you focus on? Quality, growth, or price?
So this is very close to my heart. So when we started in 2018, markets were very tough. So between 17 and 19, quality at any price or buy at any price was the norm. Yeah. And in fact, we came out with a very simple note in 2019 and 20, which was bubble in quality. And where we explained that, yes, these are great businesses, great companies, but priced to perfection. So, one part of our investment philosophy is risk-reward ratio. Best company is not necessarily the best stock. And we are here to buy good companies, which are also good stocks. Yeah. And I think that has played to the T, So even now, we are very cognizant of the fact that multiples also matter. We are not saying that every stock will be 10, 15 PE, but the PE has to be commensurate to the growth which we are expecting. So if the growth is 20, 25%, we don't mind paying a 30, 35% PE. But for a lot of these so-called quality companies, the growth is 2%, 3%. We can't pay a 40, 50 PE to those companies. So I think you have to, manage it in a way. And as I said, definition of quality in the meets framework for us is very clear. Discipline in terms of capital, return on capital deployed. I think as long as that is there, we are pretty fine. And I think that is where we also get an opportunity to create that alpha. You mentioned why active. If you see the Nifty composition, it includes so many companies which have been great in the past, but we don't know whether they will continue to be great in the future. And I think that is where the opportunity also lies.
And in this context, what would be your view on the current market?
Markets are tough, frankly. We are very positive 10, 15 days back because everything was falling in place. Oil had fallen to 70. Rupee was going to 93, 94 with oil coming down, imports of gold and silver coming down, and with this FCNR thing. I think Trump has created a near-term issue with oil moving back to 95. But our view is that fundamentally oil will be 70 or maybe less. Fundamentally, rupee has to come back to 93, 94. Foreigners have already started looking at India again after 2 years of selling, and we have seen decent positive flows. If oil would have not moved to 95, maybe the flows would have been stronger because the global AI trade is now no more a one-way trade. So things are looking pretty decent. There was a concern about El Nino and monsoon. I think now in a lot of places we are seeing more than what we want. So hopefully, we will end the season with maybe not more than 8-10% deficiency. Earnings are pretty decent. Yes, there will be some sectors and companies which will have some impact because of the war, and that impact was felt in April and May. And we are seeing in parts some impact coming in. Maybe some impact will also come in June because again last 12 days the strait is closed, so it is very difficult to export as well as import your raw materials. But I think overall we are now looking at more tailwinds and headwinds. So returns will be moderate, but we are quite optimistic.
So Reliance as a stock has created extraordinary wealth over a long period of time. But for today's investor, what is an honest, it's actually coming in from my last question.
Reliance Growth Fund.
Yeah. What is an honest return expectation from equity mutual?
So I think Reliance Growth Fund, which is now Nippon Life Growth Fund, has been a marquee fund. I think it's up some crazy 450 times. So if you would have invested 1 crore in 95, it would have become 450 crores. So it's like been more than a multi-bagger stock. I think obviously the base of the economy that time was lower. The fund has obviously done very, very well, and kudos to all those who have managed that fund, including for some part me also. I think going forward, the economy is much larger. We are now no more a $100 billion economy, we're a $4 trillion economy. So obviously the growth rates will slow down a little bit. Stocks which used to be 8-10p are no more that. We are more like 18-19p. So the re-rating as far as the P multiple is concerned is not going to be as high as it used to be earlier. But given the dynamics of the economy, even if you grow at 7% real GDP, which looks likely, and you add 4.5% of inflation, you're looking at nominal GDP growth of 11.5%. And private sector normally grows 2-3% higher than this. So 13-14% kind of profit growth we are looking at. And that kind of returns can therefore definitely be made. But even if you grow at 14%, you double your money in like 5 years. So it's not bad.
Which is great. 6% on FD plus tax. For someone watching this series who has been delaying their mutual fund journey for a while, what is the most simplest, sensible step they can take today without overthinking market levels?
So, if you want to move ahead in life, first of all, you have to accept that abhi tak jo kiya, I could have done better. So, if you have not invested so far, first you have to admit that, it was not the right decision, and you start from today. I mentioned earlier also, equity investing is about being optimistic. If you're optimistic on the future of India, if you're optimistic on the markets going forward, then you should be an investor. If you're not optimistic, you should spend the money because, you're looking at a doomsday kind of a scenario. But I think if you have not done so far, I think the best time to start is right now.
Thank you, Sunil.
Thanks a lot.
That's all I had. I think very short and crisp and direct to the point. So thank you.
And,
so
we
much.
are always positive, and our tagline is also always be positive.
Thank you.
Thank you.